Right, thank you. Thank you all for joining us today for our deep dive. This is our last deep dive of 2022, and it's one where we look forward to 2023. A little bit of context for this one: we across the corporate finance team, of which I'm a member, we have weekly catch-up calls, and in those catch-up calls, there's some, my colleagues share what I think are quite interesting insights into, the world of mergers and acquisitions and finance raising, and I just thought those insights might be useful to the kind of the wider business community in terms of shaping or maybe influencing or shaping their strategies looking forward to, say, 2023. So I cajoled three colleagues representing kind of different strands of corporate finance and business recovery to join me today. So the format, each will introduce themselves briefly and also give a little bit of background to the particular aspect of like corporate finance or business recovery they're involved with. We'll start by questions that I've put together to hopefully eke out some interesting kind of conversations between them, and then over to you for discussions. And if you can post any questions you've got into the Q&A, which is on your screen on the right hand side, if you can post them in, click on there and then post your questions in, and either I or my colleagues will pick up on them as we go through. So yeah, questions, and then we'll wrap up at 12:45. So with no further ado, I'd like my colleagues to introduce themselves, and they'll do it in order of alphabetical first names. So you can see how quick you are to work out your alphabets here. Right.
No, well, thanks, Richard. I guess that's me then. first pass, test passed. So yeah, good afternoon, everyone. My name's Jeremy Richards. I've recent joiner to PKF. My specialism is banking and debt finance. So I've spent most of my career, 25-year career, working in the various teams of commercial and corporate banks, covering institutions such as HSBC, RBS NatWest, Lloyds Bank. I also set up a business with a colleague 5 years ago where we brought to market an independent debt advisory business, utilising all of our skills gathered in that sort of banking market for all of those years, but crucially being independent and helping SMEs navigate the lending market. Primary reason for doing that is sort of post credit crunch 2008. The market very much more from being the sort of the big 4 or 5 banks to competition being encouraged in the market, and now there's well over 150 to 200 lenders that we're aware with, so it's a huge market, can be very, very complex to navigate. So we help business owners navigate that, making sure that they structure debt accordingly and get the right lender for their particular circumstances. So that is me.
Thanks, Jeremy. Thanks, Richard. My name is Michael Hall. I am a licensed insolvency practitioner based in Truro. In fact, I think I'm the only one. I'm also a chartered certified accountant, having worked in business restructuring for the last 15 or 16 years. And prior to that, I worked as an accountant in practice. And prior to that, I worked in London in structured finance. So I worked with a company that dealt with technology assets and leases and retentions and things like that, off-balance sheet lending, etc. So I have a bit of a variety of a background. My current role I'm a director at Francis Clark, as I say, in Truro, in the business recovery, and really the remit is to support local businesses and business owners in the Southwest, particularly if they are facing financial distress, and sometimes also if they are in fact solvent. So we provide formal or informal restructuring solutions, and whether the person or the company is solvent or insolvent. So that is me.
Great, thank you very much. My name is Nick Tippett, a bit more of a familiar face around here. So I've been in the corporate finance team at Francis Clark for the last 12 years. My role is purely focused on the M&A side of the corporate finance world, so buying and selling businesses, helping with management buyouts and fundraising projects. And that's been my focus for the kind of last 10 years at least. So.
Oh dear, muted myself. Right. So a question for to start with. Then, what activity are you currently seeing in your particular areas of your specialisms? What level of activity and type of activity are you seeing? So I don't know who wants to kick off that one. A response to that one?
Yeah, I don't mind. I don't mind starting. So obviously, in the business recovery and restructuring world, we're seeing a significant increase in inquiries. I think there's been a sort of change in attitude from sort of forbearance that's been seen in the COVID era to actually more of a sort of action-based recovery from creditors, and also HMRC. The insolvency statistics released in September, the period up to September 2022, shows generally an increase in an upward trend in formal insolvencies, and that's up from last year, but also significantly up from sort of pre-COVID era. In fact, general levels reduced significantly, obviously within COVID, as a result of all of the support that was provided to businesses and individuals by the government. And now that that's unwinding, we're starting to see that businesses that perhaps were not particularly viable but were supported through COVID are now at a point where they are struggling to meet their debt repayments under the COVID support, but also struggling with the general cost of living crisis, general cost rises, and which has basically put significant strains on working capital. And to be honest, it's the major sort of insolvency companies that sorts of sectors that are affected are the same as they have been in the last few years. Construction, particularly, also sort of wholesale, retail, trade, and then accommodation and food as sort of number three. There's been an increase in HMRC's activity, where they had been previously keen to support businesses. Typically in COVID, obviously they had limited powers to sort of enforce any action in COVID. They were keen on time to pay arrangements, but ultimately HMRC, I think at the start of COVID was owed 19 billion, and it's now 19, and it's now owed 46 billion. So there is a desire for HMRC to try and recover funds, and therefore we're seeing signs of enforcement action out there. Just briefly looking forward to 2023, I suppose from my side we see that upward trend in terms of pressures and formal insolvencies continuing with the likely recession through 2023, poor confidence levels, and energy prices continuing to rise, as well as sort of wages requests following inflation. So yeah, it's likely to continue along that trajectory.
Thanks, Mike.
Okay,
Should I go next, Jeremy?
Yeah, you can do. Yep.
Yeah, cool. Okay, so yeah, I guess thanks, Mike. Probably not surprising entirely to hear that, given everything that you see in the press. And what might be a bit more surprising from an M&A and corporate finance perspective is we're kind of still seeing a lot of positivity in the market. So there's a lot of transactions still happening. Deals are still going ahead. Values are holding for good businesses, and where those businesses are trading well, we're seeing continued appetite from investors on both kind of from a corporate, strong liquid corporates, and also private equity looking to undertake transactions. And so that's really continuing to drive market activity. So yeah, perhaps somewhat kind of in contrast to what you might be reading in the press about the market at the moment. But from a kind of process perspective, deals are taking longer. People are doing more due diligence, and that probably echoes through perhaps of what Jeremy and Mike are seeing in the market around that side of things as well.
Yeah, thanks, Nick. And I think I sit nicely between Michael and Nick's comments there from a debt banking and debt finance perspective. In that, yeah, absolutely, Michael's comments around sort of the unwinding of the C-bills, the bounce back loans, and those government-backed schemes. We're definitely now seeing a lot more refinance conversations going on. how new lending interacts with that government lending. Does it need to be repaid? Can it sit alongside? An element of distress. We're also seeing another common theme we're seeing is sort of working capital, payer terms getting stretched, and also just generally the whole cycle just becoming just longer because of time to take, getting materials in. So, the likes of the construction sector, manufacturing, just everything is taking longer and therefore just eating cash, which at some point, requires funding. Sort of on that side, we're more and more sort of leaning on perhaps the challenger bank specialist lending market for certain sectors. So, things like construction, having to go to lenders that truly understand the nature of the debt, how those businesses operate, rather than perhaps sort of the general lens of a bank that's, under a more generalist team. So it's very important from our perspective to know what a client's looking to achieve, perhaps, what are some of the risks in that business, and match that up with the right funder. Going forward, I mean, it's not all bad news. I mean, what do we see? The banks are well capitalized. They've still got strong balance sheets. All indications are that all of the high street banks, are still very much open for business and looking for new business, which is encouraging. I do think that credit will become tighter. So I think there'll be a lot more checks and balances. Going to Nick's point, just things will take longer to do, and perhaps the appetite won't be there. But there is also this alternative and challenger bank market. There's a lot of other lenders out there that equally that are well funded, got good funding lines that can work very, very well alongside your banking partner to support any debt activity. So it's from our side, it really is it's two sides of the story. I think there's going to be those businesses that struggle to refinance, just things become difficult, but equally there are businesses out there that are performing very, very well. They're through the cycle businesses, so technology businesses I'd put into that pot, which doesn't matter where the economy's going. Generally these businesses will perform strongly and will warrant being able to get debt to support their growth ambitions.
Sorry, Jeremy, you mentioned there about the kind of additional due diligence going on into kind of projects, and the bank's focus on checking from a transaction perspective. On the M&A side of things, we're really seeing a focus on forward-looking financial projections, sensitivity analysis, and really kind of scenario playing around what might happen and what could happen and what that would mean. Are there any particular areas that you're seeing on your side of things from the banking perspective? Are they kind of still looking back and looking at adjusted, or are they kind of taking EBITDA and then kind of starting from the projections? What's your kind of view on what's
Yeah, I mean, it depends on the situation. So if a business is looking for growth financing, of course, there's going to be that look forward. Where are we going with this? What's this debt going to achieve? But there's also a real strong view on what's happened on the look back period, particularly with COVID. It is almost of an element that the lenders like to have historically a nice, where has a business come from the past 3 years? What's been the profit? What's been the EBITDA generation of that business that can service the loans? And then we'll take some of the upside on that. To a degree, that thing called COVID destroyed that sort of model a little bit. So we are seeing lenders almost drawing a line through sort of 2019 back into 2020, and just bridging that period, saying what was 17-18 looking like, now what's 21, what's 22, and then looking at the forecast. So taking a much more pragmatic view, understanding what's gone in that market. But yeah, I think there is still a strong focus on what's happened before. What were the key drivers in that, with obviously a nod to what's going to happen in the future underpinning the debt.
Thanks. That's kind of really interesting, because I guess that forward-looking EBITDA, like you said, COVID made kind of looking at historical EBITDA quite difficult, because nobody really knew what was kind of in inverted commas normal. So the forward-looking, certainly from our perspective, has become more kind of a focus, which you understand. And Mike, you've probably got quite a lot of businesses that have been through really positive times through COVID, and things aren't quite so good at the moment. What are they doing around looking forwards?
Yeah, that's it. That's right. And I think in some cases the COVID support has masked sort of underlying issues within businesses. And And plus, in some sectors, obviously, there's been a significant uptick in activity, such as the accommodation sector, in 2021, particularly down in the southwest in Cornwall. I guess they were good years, 2022 to a degree. And what we're finding now is that there is a real need for a sort of sanity check, a sort of step back, and sort of almost you take out the COVID support, and then you look at it as sort of fresh, really. And one of the issues we see a lot of the time is about forecasting and about management information. Some businesses have better systems than others. Some are more accurate, but also it's not just necessarily producing the forecast. It is about having different scenarios potentially, and looking at sort of best case and a worst case, monitoring the assumptions that the business is sort of making, and also changing them as information comes to light, so that it's actually realistic, it's sort of objective, and it's prudent, because that way you can assess the viability, you can assess the sort of pinch points. Obviously, you've got funding, repayments on the recovery schemes, and the bounce back loans and the CBILS have obviously been kicked in for a while, and some of the businesses have kept those monies. They took the finance, they've kept it sort of in hand, and obviously that's now eroding as the sort of the repayments are going through, and it's sort of what's the plan for the future when that those reserves are depleted, and more importantly, I suppose it's looking at things like margin. I mean, that's one of the key issues that we see often, is businesses that are activity wise very, very buoyant, but quite often it's the profit margin that's the issue. It's the actual are they making enough money to support the rising costs, but also where you've got owner managed businesses, quite often there can be issues with money going out to to the owners, shareholders, directors at sort of certain levels, which actually are not adjusted for the current state of the business. So there's then shortfalls in working capital, which then tends to lead to accrual of debt, and ultimately, if those companies are to go, those companies go into some sort of insolvency procedure, that those dividends or whatever, where there is not sufficient reserves, will be a debtor that will need to be met. So this all comes down to making sure that people have good, accurate management information that's monitored, on a weekly basis, almost a short term and a medium term, to base decisions. Otherwise, it's very difficult. It's very difficult to plan.
Yeah, and very similar, Michael. When I think when we're working with the lenders, getting new debt from a lender's perspective, I think they're going to expect a lot more detailed information from business owners now. The high level business plans just aren't going to work. It really is understanding all of that detail that you've described. And what we're seeing as well is obviously coming out the other side is post management of debt, things like covenants, how they're going to be set, how they're going to be managed, because no lender wants to enter into a relationship today where there could be potential issues down the line. So critical in being able to get that picture correct is quality information packs and good quality financial modeling, and that it has to be the profit and loss, the balance sheet, and more importantly for lenders, the cash flow, and really understanding that cash dynamic. What are the different levers that can be pulled in that business that can really can really impact cash, that could potentially trip up loan repayments? So the sensitivities are concentration on debtors. What happens if 30-40% to one customer and you lose that? How does that impact your debt? That's very important. There is a real focus on HMRC, obviously with their preferential status now. So what impact does any HMRC arrears have on any future cash availability for debt? So it really is very important for any business now approaching their banks or lenders for new debt or refinance to really understand over the next sort of 2 to 3 years how cash is going to play out and forecast it accurately.
Yeah, and all of those kind of themes. Sorry, Richard, jumped straight in. Didn't give you a chance, but all of those themes kind of echo through to what we're looking at from the corporate finance perspective. So businesses, owners, whether they're looking to sell or kind of secure value into the future, that kind of standing back, taking a really good like holistic view of the business, perhaps kind of bringing themselves out of the detail a bit and just seeing, what can be done now to protect that value and what action should I be taking to ensure that I'm not exposed, kind of sits, beautifully in line with what you're saying, Jeremy and Mike there.
And that to be fair, Nick, is exactly what we see these sort of themes about centering around cash flow, and Jeremy mentioned there about sort of debtors and resilience in terms of customers. And I think that is where we're going out and seeing people. We approach our sort of restructuring assignments from a rescue perspective, really. So we're looking at sort of what's happened in the past, what's the reasons for the issues, is it one-off, is it systemic, and then we really sort of look at what can be done to try and remedy the situation on an informal basis and try and exhaust all of those paths. So we talked about the management information and the robustness. Ultimately, you can look at customers as well. Over reliance on a small number of customers is never a good thing. Profit, margins eroding due to sort of cost increases and sort of potential review of pricing, regular review of pricing side of it. Also, if the reserves are small, then there's going to be issues with finance and getting credit, which ultimately is going to impact on things. And as I sort of said earlier, we also sort of have to look at things like the credit control side of it. So we look at sort of things like our terms and conditions for customers. We look at things like the sort of credit searching, things like retention of title, so that businesses have a little bit more of a ratchet to protect themselves in the event that their customers start to struggle. Equally, you can look at suppliers in the same way. Look at the supply chain, look at the weaknesses that are there, try and not be over reliant on one particular supplier as well.
Yeah. And on those sides as well, it's we've seen in the market, particularly with those businesses that use sort of invoice finance type facilities, they're sort of looking at the credit insurance side. Any business out there that works closely with their credit insurance provider, they've actually got some very smart tools that can look at customer profiles. Where are they? What are the limits you should be setting? And as importantly, your suppliers as well. So I think use those insurers, use the people or relationships you have with people like credit insurers, and use the tools that they've got available to make smart decisions.
Yeah, and it's also for bearing in mind that some of the agencies, that some of the information isn't always right up to date. So it might be also worth speaking to customers and getting that up to date management information from them, because even it could be a few months out of date from when it's updated from Companies House, and obviously the historic side is 9 months post year end. So it's always good to get a number of sources and
All right. Sorry. Well, lovely. Anybody external got any questions? Then please start, asking them on the Q&A. One aspect I'd just like to kind of go back on is if one contrasts like the situation now with 2008-9, I think, Jeremy, you've already kind of touched on one of the big differences now is the availability of finance. Is that correct?
Yeah. I mean, I was sat at RBS during 2008, so I can come at this from a very experienced point of view. No, it doesn't feel like 2008 at all. The government regulation and the Bank of England, support that they put in and the ring fencing measures, all the banks are well capitalized. As I said, there is no indication that credit's going to tighten up. What I do think is there will be more caution. There's the obvious sectors. I think construction, leisure, retail. The banks are going to be looking at those carefully. Will they have maximum appetite in those sectors? Probably not. But there's other sectors out there that technology we've touched on that will still be well supported. And again, the sort of the alternative finance market, a lot of those lenders went and raised a lot of liquidity over the last 2 years, backed by pension funds, insurance funds, asset managers, and actually sit on quite a nice bank of cash that they have to deploy. So very similar, Nick might be able to allude to this sort of in the private equity world, but in that sort of alternative finance, private debt world, there is a lot of cash out there that can be used to support SMEs. I think the high street banks will start to lean more on asset-backed lending strategies. So they understand what assets are on there, so in any downturn situation they can recover their money. So it might be that a business that needs an unsecured, so not physically against an asset, so it might be a technology or a very asset-like business, might have to reach out to that alternative market, who really understand cash flow generation, how is the dynamics of that working, and there is good there's good availability of cash out in that market. To support growth, acquisitions, refinances, so all purposes right across the board. So yeah, it certainly doesn't feel like a 2008, but I think it feels going into a more cautious normal, I think is probably the phrase to use. But don't expect to be there a wholesale sort of a dry up of funding. No.
Nick, would you echo the availability of finance is one of the the reasons that the mergers and acquisitions are still carrying on?
Yeah, I would. Probably from a less experienced position as Jeremy, as I was 2008, I was just sitting some exams. But what I've kind of seen over the last 10 years really is a real transition and a real growth in the number of those alternative finance providers and funding options available for businesses. And the market has changed hugely, which is why Jeremy's joined the team really, because of its kind of the market knowledge around that. But just from an on the grounds M&A perspective, look, lots of funding options available for businesses, a lot of dry capital out there from private equity and also really liquid corporate businesses that have generated significant cash reserves particularly over like the COVID period, and they're looking at ways to generate return from that and sit that alongside, like Jeremy said, 150 to 200 alternative debt providers. And those kind of funding providers are really focused on different areas. They will look at different asset bases. They'll fund on different structures. There is a wealth of different kind of funding available for sure.
Lovely. I don't know if you maybe just have a look at the questions that arrived on the Q&A, and if any of you fancy picking those up, we'll pick those up shortly. Bit of a left field one to go with in terms of, are you ESG, environment, social and governance, how are you seeing those impacting, if at all, on your particular kind of areas of specialism? Jeremy, I'll post this one to you first of all, because I've seen something you've written that comments on the green finance. So
I thought it's worth raising. So what we are seeing in the market, particularly amongst the high street banks and sort of the big sort of institutional lenders, is a real focus on supporting green energy agendas, and that can be anything from large real estate asset owners looking to move their EPC ratings from Ds to Bs, and if funding can evidence that. If funding can evidence that is a big part of that transition, the banks can actually give pound note discounts. So it's not sort of a wooden dollar discount in the background. We're actually seeing margins being reduced to actually fund those capital projects. Also funding going into electric vehicles, renewables. It's quite a keen space. So any business looking to sort of transition on that green agenda side, funding those capital projects, I think will be be quite an interesting conversation with any of your lenders, and something they'd be keen to support.
Yeah. Nick, any kind of mergers and acquisitions kind of thoughts on ESG? Is it more or less kind of visible in terms of types of transactions, maybe?
Becoming increasingly, I would say at the moment, it's not the central focus for businesses. Looking at M&A, there's more around driving the returns and the synergies that come from that. But I think as we kind of see, like Jeremy said, the different funding structures coming through, certain private equity funds have kind of ESG goals and clear stated objectives, and so we're starting to see some of that trickle down to kind of mid-market transactions. Do I think it's the centre point of people's agenda on M&A at the moment? It's probably not, but I think it is increasingly becoming important. And I know the likes of the Business Growth Fund do focus on ESG, and they're kind of helping all of their portfolio companies kind of upskill in their ESG. So it's clearly becoming an agenda topic, as it should be. Yeah. But it's not central at the moment, I would say, to mid-market M&A deals, but becoming increasingly more important.
Mike, I don't know if you want to say anything on that, or
well, I can do quickly.
Or you can pick up on Henry Maples, the question in the Q&A.
Well, I'll quickly say about we're not seeing a huge amount of impact on ESG on our work, but obviously, as everyone's mentioned, it is going to be more prevalent moving forward amongst lenders and even, just all the stakeholders probably. But as a team and a firm, we are. Francis Clark are passionate about improving the ESG credentials, and we've committed to start the journey to being B Corp accredited, and we hope to be the first insolvency practitioners to do so.
Wow!
So there we go. I did have something to say.
That was yeah. I suppose actually, sorry. Before we leave, kind of I suppose maybe a question for, maybe just one of you can, in terms of energy costs are obviously an issue. What are you seeing any kind of themes in terms of mitigating actions? I'm aware from some of the work that I do that, that people are maybe investing, more in renewable and or battery. Is that something you're seeing in any of the aspects of the work that you do?
So obviously our energy and infrastructure guys, as you know, Richard, and the team have been particularly busy on the kind of larger projects, and there's a lot of activity in that sector because there's a clear focus on it. People are, the payback period on renewable energy sources for industrial use are shortening because of the rising cost of energy. But what we're seeing as a kind of, so people are investing in that, putting solar panels on roofs and looking at different heat sources and things. But the kind of the biggest changes we're seeing is around particularly on the manufacturing side, where people are looking at changing shift patterns and operating times to try and make better use of energy at lower costs. So what people have been seeing is that actually you might be able to bring forward your kind of when you start up the machinery, because the kind of whole warm-up process takes it takes a lot of energy, and actually you can do that earlier and then run it at a higher level over the period, and that saves you money just because of when you're drawing down on the energy usage. The other thing that people have been thinking about is shifting the kind of shifting the manufacturing patterns to basically get staff in early or staff working later in different shifts, and offering staff increased wages, which is addresses the kind of cost of living issue, but as a kind of result of those potentially kind of unsavory hours, but that is then benefiting the company more because of the energy savings they're making. So it's just that comes back to what we were kind of saying earlier around really thinking about the different options and what what changes could you make that might benefit your kind of wider stakeholders, but make use of the kind of different pricing offers and things like that are around.
And that's something that presumably, because each of you mentioned projections and kind of scenario planning, so presumably that's something that can be modeled through in a set of projections by looking at, say, different pricing of energy for reusage, and then also presumably like flexing the wages to see what the kind of the net impact is in terms of profitability.
Yeah, absolutely.
Yeah, we can imagine that wages, requests for wages increases in light of the inflation rises that we're seeing will probably continue, and it's has a major impact on the bottom line. So it's good to have those sort of sensitivities, within your cash flow to adopt that sort of worst case scenario, to give yourselves a bit of leeway and protect that sort of working capital, which is the lifeblood of the business at the end of the day.
All right. So, Mike, did you want to pick up Henry's point? Can you see Henry's point?
Yeah. So the valuation of intangible assets is a complex area at the end of the day, and as an IP, I would instruct a sort of specialist agent to conduct that, and it really depends, I suppose, on a number of factors, such as the sort of the goodwill value generally of the business, and I suspect that it may well mirror some of the changes in the market and changes for appetite of lenders, but I've seen big wide variations on IP asset value over the years, so it's a very specialist area.
Right. Thank you. I don't know. I assume that was a question, especially for Mike there. So unless either.
Well, I was going to touch on it, Richard, because it's actually a really interesting question from a lending point of view. So when I was at the bank, as businesses generally move to a service base, and there's a lot of technology businesses, there's a huge amount of IP and intangible assets generated that are highly valuable. And it was sort of an ever ongoing conversation internally at the banks on, what is the value of that? Because, there's an incredible amount of money being spent on building up an IP base for a good software business that, going into Nick's world of selling a business, and that underpins all the value. So should banks be, looking at ways of bringing in expertise to leverage that asset off the balance sheet? And I know that the banks are bringing in experts within those areas to look at specific, technology assets and really get a good understanding, because lenders have to get their head around it, because that the market's going to gradually move more and more that way, and if we're underpinning debt on plant and machinery, you're going to very soon, only be able to serve a third of the market. So for banks to be able to really understand that IP, the value in intangibles is very, very important, and it is sort of a growing industry behind the scenes on getting expertise brought in-house to do that.
Maybe a new job opportunity for me there then. Nick, did you fancy the first question that came in?
Yeah, very happy to. Just checking, Richard, can everybody see these questions?
No, well,
okay,
I could actually. Right, I
That's
will.
Fine. Oh no, it's fine.
It's now published.
There you go. Okay, so just a question around what the firm has in terms of systems and processes, in terms of looking at M&A and operational synergies between client base. I guess we don't have a formal system in place for doing that, but if you're as a business, if you're considering M&A opportunities, whether you're looking at an exit or looking at acquisitions, we're very happy to kind of sit down and have a discussion with you around what it is you're looking to achieve and what might be good partners for you. We can then feed that back through the partnership to see where that sits. And then in terms of the kind of operational efficiencies, where we typically see that is through the kind of general practice partners, through introducing the clients to one another through their network. So kind of becoming part of that Francis Clark cohort and attending different events that we host. So, we often host FD seminars, for example, and drinks events and things. Those aren't just about the kind of technical and social side. It's also that opportunity to network with other Francis Clark clients. And that kind of cohort piece gives people an opportunity to explore those synergies.
Thank you. And then, Jeremy, I think there's probably the two that I haven't published yet are probably. Do you fancy those? The two questions?
Yeah, I think one was the underlying capitalization of banks in relation to bonds. Christ, you could have a whole debate on this for a whole 2 to 3 hours and bring in a very seasoned economist, I think, to discuss those.
You could extend this webinar.
Yeah, you can extend the webinar, and I think perhaps it is a point for another deep dive. We can look to bring perhaps one of the bank's economists in to have sort of a deeper dive on these issues. But yeah, absolutely. Government bonds are a safe haven for money. Trust and Quasi came in, and did what they did, and those bonds then perhaps became not such a safe haven. We were seeing going up to 4.5%. The forward-looking sort of 10 and 30-year positions have fallen back to, I think the last time I looked, sort of 3.5%. So there is still the safety net in that, but there is so much going on in the world at the moment. None of us can say. You would hope the UK is always a strong bet. But there's so much going on in the macroeconomic world that and things happen so quickly. It's just, in my view, impossible to forecast.
I would say, kind of probably answering the second part of the question from Mark there around the kind of will credit suddenly dry up like it did previously. I think it's important to look at how a lot of the alternative finance providers are funded. So traditionally it wouldn't have been the case, but a lot of them are funded more like private equity funds, where they've got their funds coming from private capital who are looking for kind of more balanced equity type returns, and that's a very different situation to kind of previous times.
Yeah, no, absolutely, Nick. And I think that is this sort of this wall of liquidity, as they're calling it. It is that insurance, pension fund, asset managers who are looking to deploy cash into the SME market because they see it as it's clearly not a risk-free return, but there is a good return versus risk downside. Pricing that in at sort of 6 to 7%. So therefore, it's good from a balanced portfolio position for these type of backers. And you're quite right. That's why we're seeing good availability of cash in those particular funders, particularly the ones that have lent sensibly and have got good technology behind them. So I put an Oak North, in there. They've got some very, very smart tech that can analyze company data, as well as doing a proper eyeball on a credit.
So sorry, Jeremy, just picking up on that.
Mm.
Is something like effectively AI, or are we seeing increasing use of AI or analytical programs in terms of
decision making? Absolutely. There is a little bit of so there is a little bit of the COVID situation broke the algorithm. The historic trends on data, it was very nice for lenders to pick up that historic information. That sort of stopped in 2020, but it's come but it is coming back. So therefore, underwriting is becoming a manual process again, with experienced people who have been through downturns and situations to analyze businesses. But there's technology, so open banking is the big one that most people would have heard of. So the ability for a lender to get signed up to actively look straight into the company's bank account gives a far more accurate picture of the now, rather than relying on data that could be 12 or even 18 months old that's been prepared by the company's accountant. There's nothing like the bank account to go through to see what really is happening day to day in that business at this moment in time. And banks are increasingly, and lenders, relying on technology such as that to make lending decisions, along with the good old-fashioned tried and tested experienced underwriting officer.
Thank you. And just as we head towards the 45 minutes, maybe just a couple of points from each of you about maybe aspects that if you put yourselves in the shoes of an owner manager, aspects that you would be maybe paying more attention to or doing differently at this time than you would have so maybe pre-COVID. So I think I've got that projections are key. I've also got that management accounts are probably going to be increasingly important in terms of all of your areas of work. Nick, I got from you that that kind of strategy, standing back and kind of thinking about how the business may perform, and I suppose also the feasibility of those plans. Any other kind of final points from your experiences at the coal face, so to speak, in terms of what's happening?
from me, I think, Richard, just on top of what you're saying there, it's around that scenario planning. So it's okay having projections and it's okay having good management accounts, but it's actually then how you use those. So stepping back and saying, actually, what if this opportunity arises, or what if this challenge arises? What actions would we take? Because then as those opportunities and challenges do arise over the next 12 months, which inevitably they're going to, I think you'll be much better placed to make the right decision on what action you should take and be able to do that quicker.
Yeah, and I think dovetailing into that, Nick, absolutely from a lending point of view, look at those forecasts, look at where the potential pinch points are, and with your bank or your lenders, don't wait for that to happen and then go and ask for help. Preempt it by saying we foresee in 6, 8, 12 months this becoming a problem. Go and get credit lines approved, go and get capacity in your debt, go and get an idea of what money you can borrow. You don't have to draw on it, but try and get some commitment from a lender that things are achievable. So when you do need to press the button, you can act quickly, because things are taking longer now. We're seeing debt lends taking 3 to 4 months, and for a business that could be up against it or has got a potential pinch point, you wouldn't want process and the length of time to trip something up that could have ultimately been solved.
No, thank you.
Yeah, and I'd echo Jeremy's point about looking ahead and planning, and from a sort of restructuring perspective, as we've talked about, the sort of the forecast and management information, the scenarios, the good situation, the bad one in the middle. It's important that if issues are sort of identified as soon as possible, then early advice is key, really, to get advice from our side, from a restructuring perspective. Informal advice without cost obligation at an early point leaves the way open to a lot more options open to the business than if it's done further down the track, because it could be that a simple sort of restructuring on an informal basis would be sufficient, but if the matter is sort of left, then it does diminish the options open to the business and might point it more towards a sort of formal insolvency restructuring, which is it's not can be avoided if actions are taken sooner, and also thinking outside the box, where you've got opportunities that have come about due to COVID. There might be premises that are underoccupied. Can those be sort of redeployed? Assets that are underused, can they be maximised? By subletting or whatever, and so there's a number of things that should be considered as well to sort of to turn situations into opportunities.
All right. Lovely, and on turning situations into opportunities, which is a lovely way to finish. Thank you, all three of you, and thank you to everybody who's tuned in and listened, and also thank you to Joseph for sorting out the tech, and particularly for sorting out my tech this morning. So, thanks to Joseph, and thanks to everyone, and I'm sure we'll see you all again in the new year. Obviously, if you want to speak to anybody from Francis Clark before then please do. But thanks a lot. Thank you. Bye.
Thank you.
Thanks very much.